After 4 decades, managing capital for institutions that must pay obligations for 30, 40, even 50 years into the future, I have learned something that most individual investors never understand. The portfolios that survive are not the ones with the highest returns. They are the ones built with the right structure. Today I am going to share with you the exact framework that pension funds, endowments, and sovereign wealth funds use to manage money across multi-decade time horizons. This is called the bucket strategy. And if you implement it correctly, you will build a retirement portfolio that can last 30 years or more without ever running out of money. Let me start by explaining why most retirement portfolios fail. The traditional approach is simple. You build a portfolio, maybe 60% stocks, 40% bonds. You retire. You start withdrawing 4% per year. You hope it lasts. This approach has a fatal flaw. It treats all your money the same. It assumes you can afford to have your entire portfolio exposed to market volatility. But you cannot. You need some of that money next month to pay your mortgage. You need some of it next year for property taxes, and you need some of it 20 years from now to fund your later retirement. Those are 3 completely different time horizons. They require 3 completely different investment strategies. When you mix them all together in one portfolio, you create sequence of returns risk. If the market crashes right after you retire, you are forced to sell stocks at depressed prices to fund current expenses. You lock in losses. You reduce your share count permanently. Even when the market recovers, you never fully participate because you sold too much at the bottom. The bucket strategy solves this problem. Instead of one portfolio, you build three separate buckets. Each bucket has a different job. Each bucket has a different time horizon. Each bucket has a different asset allocation. Let me walk you through each bucket. Bucket number 1, the safety bucket. This is your cash and cash equivalents. Money market funds, treasury bills, short-term certificates of deposit, high-yield savings accounts. The goal of this bucket is simple: liquidity and safety, zero volatility. You want to be able to access this money instantly, without any risk of loss. How much goes in the safety bucket? 2 to 3 years of living expenses. If you need $40,000 per year to live, you keep $80,000 to $120,000 in this bucket. Why 2 to 3 years? Because historically, that is how long it takes for the stock market to recover from a significant downturn. The 2008 financial crisis. The market took about 3 years to get back to its previous highs. The dot-com bubble, closer to 5 years, but on average, 2 to 3 years is your cushion. Here is the magic of the safety bucket. When you have 2 to 3 years of expenses sitting in cash, you become emotionally immune to stock market crashes. Let's say you retire and the market immediately drops 30%, devastating for most retirees. But not for you. Why? Because you do not need to touch your stocks. You have 2 full years of expenses sitting in cash. You can wait, you can be patient. You let your stock portfolio sit there and recover. You do not sell a single share at depressed prices. You have eliminated sequence of returns risk. This is exactly what pension funds do. They keep a liquidity buffer, so they never have to sell long-term assets at the wrong time. Now I know what you are thinking, but cash earns nothing. I am losing purchasing power to inflation. 2 responses: real estate investment trusts, high-grade corporate bonds, investment-grade municipal bonds. If you are in a high tax bracket, the asset allocation for this bucket is typically 50% bonds, 50% dividend stocks, or 60-40 if you want to be more conservative. The income bucket serves 2 purposes. First, it generates yield. Bonds pay interest. Dividend stocks pay dividends. This income can either supplement your withdrawals or be reinvested. Second, it is your refill mechanism for the safety bucket. Every year you move 1 year's worth of expenses from the income bucket to the safety bucket. You are essentially refilling your cash reserves so they never run dry. Here is how it works in practice. You retire with 3 years of expenses in your safety bucket. Year 1, you spend 40,000 from the safety bucket. At the end of year 1, you sell 40,000 worth of assets from your income bucket and move it to the safety bucket. Now you are back to 3 years of expenses in cash. You repeat this every year. As long as your income bucket is growing modestly or at least holding steady, you can keep refilling your safety bucket indefinitely. The income bucket is less volatile than pure stocks, but it still participates in market growth. It is your stabilizer. It is the bridge between safety and growth. Bucket number 3. The growth bucket. This is your long-term money, money you will not touch for 10, 15, 20 years. The goal here is growth. Aggressive growth. This bucket is designed to outpace inflation and ensure your portfolio lasts 30 years. What goes in the growth bucket? Stocks. Domestic and international equities, broad index funds, quality dividend growth stocks. Some allocation to real assets like infrastructure or commodities for inflation protection. Small cap stocks for additional growth. The growth bucket is heavily weighted toward equities, 70 to 80% stocks, 20 to 30% other growth assets. Why so aggressive? Because this money has a long time horizon. You do not need it for a decade. It can afford to be volatile. If the market drops 30%, this bucket drops with it. But you do not care. You are not selling. You are not touching it. It has 10 years to recover. And historically, over any 10 or 15-year period, stocks have always recovered and grown. The growth bucket is your inflation protection. It is what ensures that your purchasing power in year 20 of retirement is still intact. It is what allows you to maintain your lifestyle, even as healthcare costs and living expenses rise. Now, here is the critical part. How these 3 buckets work together. In year 1 of retirement, you spend from the safety bucket. At the end of year 1, you refill the safety bucket by selling from the income bucket. At the end of year 2, you do the same. Sell from income, refill safety. But every few years, maybe every 3 to 5 years, you also rebalance. You look at your growth bucket. If it has grown significantly, you sell some of those gains and move them to the income bucket. You are harvesting growth and moving it down the chain. Growth bucket refills income bucket. Income bucket refills safety bucket. Safety bucket funds your life. A 20% gain over 3 years. You sell 80,000 of that gain and move it to the income bucket. Now your income bucket is replenished. You have reset the system. You can run this for another 3 years. The beauty of this strategy is that you never have to sell your long-term growth assets during a downturn. Even if the market crashes in year 2, your growth bucket might drop, but you do not touch it. You keep spending from safety. You keep refilling from income. By the time you need to tap the growth bucket, years have passed. The market has recovered. You sell at much better prices. This is how institutions think. They match assets to liabilities. They match time horizons. They build buffers so they are never forced to sell at the wrong time. Now let me address some common questions. First, what if the income bucket runs out before the growth bucket recovers? This is where conservative planning matters. You size your buckets appropriately. If you are worried about a long downturn, you make your safety bucket larger, 4 years, instead of 3. You make your income bucket larger, 10 years instead of 7. You shrink the growth bucket slightly. You are trading some long-term growth for more near-term security. It is a dial you can adjust based on your risk tolerance. Second, what about rebalancing within each bucket? Yes, you should rebalance within your growth bucket. If stocks have run up and now represent 90% instead of 70%, you sell some and buy bonds or other assets to get back to your target. This is classic rebalancing. Sell high, buy low. You do this maybe once a year. Third, how does this strategy change as you age? As you move through retirement, you gradually shift allocations. In your 60s, maybe your growth bucket is 60% of your portfolio. By your 80s, maybe it is only 30%. You are slowly becoming more conservative. You are reducing equity exposure as your time horizon shortens. But you never go to zero stocks. Even at 90, you still need some growth to combat inflation. The bucket strategy is not set it and forget it. It is dynamic. It evolves with you. Fourth, what about taxes? This strategy is tax efficient because you have control over when you realize gains. You can harvest losses in down years to offset gains. You can withdraw from tax-deferred accounts in low-income years to fill up lower tax brackets. You can let Roth accounts grow tax-free in the growth bucket. The bucket strategy gives you flexibility. Finally, does this actually work? Yes, this is not theory. Pension funds have used variations of this approach for decades. Endowments use it. Sovereign wealth funds use it. It works because it is based on sound principles. Match assets to liabilities. Manage liquidity. Avoid forced selling. Let time work in your favor. I have seen this strategy carry retirees through the dot-com crash, the financial crisis, the pandemic. It works because it is built for reality, not for perfect conditions. So here is what you do. Take your current portfolio, divide it into 3 buckets based on time horizon. Safety for years 1 to 3, income for years 4 to 10, growth for years 11 and beyond. Allocate appropriately. Safety is cash, income is balanced, growth is aggressive. Set a rebalancing schedule once a year. Review and adjust. Build the waterfall. Spend from safety, refill safety from income, refill income from growth. That is it. That is the structure.